Hi, this is Brandon Bischoff with Canterbury Investment Management bringing you this week's Canterbury Market Update. The week is August the 5th, 2019. And so the market really just got hit in the face with a cold glass of water, sending it into a transitional market environment, which is caused by a single day anomaly or a spike in volatility. And so we have been talking about this happening, or the possibility of this happening, for the last couple updates, where volatility continues to decline. It's like the squeezing down of the spring, and eventually the market would need to relieve some of that pent-up pressure in the form of an outlier day. Now, the market could have just as easily ran up an additional 5 to 10% before experiencing that. It just so happened that that outlier day came on Monday at minus 2.93%. A little bit of perspective, we went the last 30 days or 30 trading days in market state 1 without seeing so much as a day beyond plus or minus 1%. So we see that additional squeezing down to where it relieves that pressure in the form of that outlier day. And these spikes are often going to be way overhyped by the news media. And so if you turn on the news, they're going to try to attribute it to many different factors. Maybe it's Trump and tariffs with China devaluing their currency, or the Fed saying we're going to lower interest rates, but they're not going to give any indication of lowering interest rates in the future. If we look at the market, from peak to where it is now, it's down a little bit over 5%, which is barely a market pullback. And so when the markets experience this, kind of shock or cold glass of water to the face, it just needs a little bit of time to regain its footing and figure out where it wants to trade. Because markets are ultimately driven by supply and demand, which is caused kind of by human emotion. So news events don't really drive market events. The market we've been talking about was already set up for something like this. It was on extreme low volatility. We knew it had the possibility to spike. It was just waiting on the random news event to come in and trigger that motion. And so another example of this is if we go back to December 2018, where we saw the market drop 20% over a relatively short period, and then snap back 10% over like 18 trading days. The most likely event from there would have been that the market, would have gone down and retested the low, but this just so happened to be a trading anomaly. So the market snaps down, snaps back, and kind of rallies back to its old high and a little bit beyond that. And over that time, investors tend to become a little bit complacent because volatility is decreasing. And so any sort of random news event can kind of come in and shock them temporarily. But again, from this point, the market just needs to regain its footing, figure out where it wants to be, and go there. And so kind of bottom line, adaptive portfolio strategy has the ability to adapt to both bull markets, bear markets, and transitional markets. And so the portfolio thermostat was positioned for the bull market environment, but it was positioned in a way that was kind of defensive. So in other words, it was holding positions that were uncorrelated to each other, but also in bull markets, so that when the market kind of experiences that outlier day, the thermostat only experiences a fraction of that, not the whole outlier day itself. And that's important for the success over the lifetime of investment, for not only your investment, but generations to come, so on and so forth. Being able to adapt to whatever market environment occurs in order to compound returns over the long term. Thank you, and I hope you have a great week.